Most people come to trading with a dream of freedom, a dream of easy money, a dream of escaping the limits of a normal life. They open charts and see opportunity everywhere. They hear stories of overnight success. They believe they are just one strategy away from winning. But what they do not see is the hidden reality. Behind every success story, there are years of mistakes. There are losses that taught hard lessons. There is discipline built slowly over time. The market does not reward excitement. It rewards patience. The market does not reward speed. It rewards control. Yet most beginners enter with the wrong mindset. They rush. They overtrade. They chase profits. And slowly, they lose. Not because the market is unfair, but because they believed in illusions. As Benjamin Graham once said, the individual investor should act consistently as an investor and not as a speculator. This is where the problem begins. People do not treat trading as a skill, they treat it as a shortcut. They want results without process. They want rewards without discipline. And this leads to the most dangerous belief of all. The belief that trading is a quick way to get rich. This belief is the foundation of many mistakes. It pushes traders to take risks they do not understand. It makes them ignore patience. It blinds them to reality. If you truly want to succeed in trading, you must first destroy this illusion, because until you let go of the idea of quick money, you will never build lasting wealth. And that is exactly where our journey begins. In the next chapter, we will break down the biggest illusion of all. Chapter 1. The Myth of Quick Money. The biggest illusion in trading is the belief in quick money. This idea attracts almost everyone at the beginning. You see charts moving fast. You hear stories of people doubling their money. You watch videos showing easy profits. And slowly, you start believing that trading is a fast path to wealth. But this belief is dangerous. It changes how you think. It changes how you act. Instead of learning, you start chasing. Instead of planning, you start reacting. Quick money creates urgency, and urgency creates mistakes. You begin to take trades without thinking. You enter positions without proper understanding. You risk more than you should. All because you want results fast. But the market does not care about your speed. It moves on its own terms. It rewards those who wait. It punishes those who rush. Many beginners win early. They take a few trades and make money. This gives them confidence. But it is not real skill. It is often luck. And this early success becomes a trap. Because once they believe it is easy, they increase their risk. They trade more aggressively. And then comes the loss. A loss that removes not just profits, but also confidence. This is how the cycle begins. Win fast, lose faster. The truth is simple. Fast money is unstable. It does not last. Real wealth grows slowly. It requires consistency. As Warren Buffett once said, someone is sitting in the shade today because someone planted a tree a long time ago. Trading is no different. You must plant slowly. You must protect your capital. You must give your efforts time to grow. If you focus only on making money quickly, you will ignore risk. And ignoring risk is the fastest way to lose everything. Think about it. If quick money were easy, everyone would be rich, but most traders fail. Not because trading is impossible, but because they expect the wrong thing. They expect speed instead of stability. They expect excitement instead of discipline. The market rewards the opposite. It rewards calm decisions. It rewards patience. It rewards consistency. When you let go of the need for quick money, something powerful happens. You start thinking clearly. You stop chasing trades. You wait for better opportunities. You manage risk more carefully, and slowly, your results begin to improve. This is the shift that separates beginners from professionals. Professionals do not chase fast profits. They protect capital first. They know that survival is more important than success, because if you survive long enough, success becomes possible. But if you lose everything early, the journey ends. Trading is not about making money today. It is about staying in the game tomorrow. Every trade you take should have a purpose. Every risk you take should be controlled. You are not here to gamble. You are here to build. And building takes time. As Charlie Munger said, The first rule of compounding is to never interrupt it unnecessarily. Quick money interrupts compounding. It creates volatility. It creates emotional decisions. It destroys consistency. Slow growth does the opposite. It builds confidence. It builds discipline. It builds long-term success. So ask yourself one question. Do you want fast money? Or do you want lasting wealth? Because you cannot have both. If you choose fast money, you choose risk and instability. If you choose patience, you choose growth and survival. The choice is simple, but not easy. Most people will still chase speed because it feels exciting. But those who choose patience, those who stay disciplined, those who focus on the long term, they are the ones who win. And once you truly understand this, you begin to see trading differently. You no longer rush. You no longer force trades. You no longer expect instant results. Instead, you focus on doing the right thing again and again. And that is where real progress begins. But even after understanding this truth, another illusion remains. An illusion that destroys confidence and creates fear. The belief that successful traders always win. And that is exactly what we will uncover in the next chapter. Chapter 2. The Myth of Always Winning. After letting go of the idea of quick money, many traders fall into another illusion. They begin to believe that successful traders always win. They imagine professionals taking perfect trades. They think experts rarely face losses, and when they lose, they feel like they are doing something wrong. This belief creates pressure. Every loss feels like failure. Every mistake feels personal, and slowly, confidence begins to break. But this belief is completely false. No trader wins all the time. Not beginners, not experts, not even the best in the world. Loss is not a sign of weakness. It is part of the process. As George Soros once said, it is not whether you are right or wrong that is important, but how much money you make when you are right and how much you lose when you are wrong. This is the real game of trading. Not perfection, but management. The difference between a losing trader and a winning trader is not the number of wins. It is how they handle losses. Beginners try to avoid losses. Professionals accept them. Beginners hold losing trades, hoping the market will turn. Professionals cut losses quickly. They protect their capital. Beginners feel emotional after a loss. They try to recover immediately. Professionals stay calm. They wait for the next opportunity. This difference changes everything. When you believe you must always win, you become afraid of losing. And fear leads to bad decisions. You avoid taking good trades because you are afraid of being wrong. Or you hold on to bad trades because you do not want to accept loss. Both behaviors are dangerous. The market does not reward ego. It rewards discipline. Accepting loss is a skill. It means you understand that no trade is guaranteed. It means you respect uncertainty. Every trade has two possible outcomes. It can go in your favor, or it can go against you. Your job is not to control the outcome. Your job is to control the risk. Think of trading like a business. Every business has expenses. Trading losses are your expenses. Without accepting expenses, no business can survive. If you try to avoid all losses, you will eventually face a large one. And that one loss can destroy everything. Small losses protect you from big losses. They are not your enemy. They are your protection. As Paul Tudor Jones said, the most important rule of trading is to play great defense, not great offense. Defense in trading means controlling losses. It means knowing when to exit. It means accepting when you are wrong. This is not weakness. This is strength. Another problem with the idea of always winning is unrealistic expectations. When traders expect constant success, they become frustrated easily. A few losses can make them quit. But if they understood the reality, they would stay consistent. Even the best traders have losing streaks. There are times when nothing works. There are periods of confusion. This is normal. Markets change. Conditions shift. What worked before may stop working for a while. This does not mean your system is broken. It means the environment has changed. Patience is required during these times. You must stay disciplined. You must follow your rules. Over time, Consistency brings results. Winning in trading is not about one trade. It is about many trades. A single loss does not define you. A single win does not define you. What matters is the long-term outcome. If your profits are bigger than your losses, and your losses are controlled, you will grow. This is the simple truth that many ignore. You do not need to win often. You need to win wisely. A trader can lose many times and still be profitable if the wins are larger than the losses. This idea changes your mindset. You stop focusing on being right. You start focusing on being disciplined. You stop fearing losses. You start managing them. You stop chasing perfection. You start building consistency. And once this shift happens, trading becomes clearer. You no longer feel pressure to prove yourself. You no longer react emotionally to every outcome. You begin to see each trade as just one step in a long journey. This is how professionals think. They do not chase wins. They follow process. They know that success is not about winning every time. It is about surviving and growing over time. So the next time you face a loss, do not see it as failure. See it as part of the game. Ask yourself, did I follow my rules? If the answer is yes, then the loss is acceptable. If the answer is no, then the lesson is clear. Improve your discipline. Because in trading, you will never control the market, but you can always control yourself, and that is where real success begins. But even after accepting losses, another illusion still traps many traders. The belief that there is a perfect strategy waiting to be found. And that is what we will uncover in the next chapter. Chapter 3. The Myth of Perfect Strategy. After understanding that losses are part of trading, many traders begin searching for something else. The perfect strategy. They believe there is a system that always works, a method that never fails. A formula that guarantees success, so they keep searching. They watch videos, they read books, they test new strategies again and again, but they never stay consistent. Every time they face a loss, they doubt their system. They think, maybe this strategy is not good enough. And then they move to another one. This cycle continues. Learn, try, lose, switch, and in the end, they make no real progress. Because the problem is not the strategy. The problem is the belief. There is no perfect strategy. No system can win all the time. No method can avoid losses completely. Markets are always changing. Sometimes they trend. Sometimes they move sideways. Sometimes they become unpredictable. A strategy that works in one condition may fail in another. This is normal, but most traders do not accept this. They expect stability in an unstable environment, and this expectation creates frustration. The truth is simple. A good strategy is not perfect. It is adaptable. It gives you an edge, not certainty. An edge means a small advantage over time. It means that if you follow your system with discipline, you can be profitable in the long run. But it does not mean you will win every trade. As Richard Dennis said, I always say that you could publish my trading rules in the newspaper and no one would follow them. This shows something important. Success is not about knowing the strategy. It is about following it. Many traders already have good systems, but they do not trust them. They break their own rules. They change their plans in the middle of trades. They let emotions take control, and then they blame the strategy. But the real issue is discipline. A simple strategy followed consistently is more powerful than a complex strategy used randomly. Complexity often creates confusion. Too many rules, too many indicators, too many conditions. This leads to hesitation, and hesitation leads to missed opportunities. Simple systems are easier to follow. They create clarity. Clarity builds confidence. Confidence helps you stay consistent. This is what matters most. Another danger of searching for the perfect strategy is over-optimization. Traders try to make their systems perfect based on past data. They adjust rules again and again. They try to remove every loss, but in doing so, they create systems that only work in the past, not in the future. The market does not repeat exactly. It evolves. Your strategy should be flexible enough to handle change, not rigid and perfect for history. Think of trading like sailing. You cannot control the wind, but you can adjust your sails. Your strategy is your sail. Your mindset is your control. Without control, even the best sail is useless. As Bruce Lee said, be like water. Water adapts. It flows. It adjusts to its environment. This is how a trader should think. Not fixed, but flexible. Not perfect, but prepared. When you stop searching for the perfect strategy, you free yourself from constant doubt. You begin to focus on execution. You follow your plan. You manage your risk. You stay consistent. And slowly, you improve. Because mastery does not come from finding something new. It comes from doing something well again and again. The best traders are not those with secret systems. They are those with strong discipline. They trust their edge. They accept losses. They stay patient. This is what creates long-term success. So instead of asking, what is the perfect strategy? Ask yourself, can I follow my strategy with discipline? Because that is the real challenge, and that is where most people fail. But once you overcome this, trading becomes simpler, not easier, but clearer. You stop chasing new systems, you start improving your behavior, and that is where real growth happens. But even with a good strategy and discipline, another illusion still misleads many traders. The belief that indicators and tools will make trading easy, and that is what we will uncover in the next chapter. Chapter 4. The Myth of Indicators and Magic Tools. After searching for the perfect strategy, many traders discover indicators, moving averages, oscillators, signals. At first, these tools seem powerful. They give structure, they give direction. They make trading feel scientific. And this creates a new belief that indicators will make trading easy. So traders begin adding more. One indicator becomes two becomes five becomes many. The chart slowly fills with lines and signals, and instead of clarity, confusion begins. Different indicators give different messages. One says buy, another says sell, one shows strength, another shows weakness, and the trader stands in the middle, unsure, hesitating. This is the problem with relying too much on tools. They do not simplify thinking, they complicate it. The truth is simple. Indicators are not the market. They are only reflections of price. They are based on past data. They react after the move has already started. They do not predict the future. Yet many traders treat them like answers. They wait for confirmation from indicators instead of understanding what is actually happening. This creates delay. By the time all signals align, the opportunity is often gone. Or the risk becomes too high. This is why many traders enter late and exit too late, because they depend on confirmation instead of observation. Price itself is the truth. Everything else is secondary. Price shows real-time decisions of buyers and sellers. It reflects fear. It reflects greed. Indicators only process that information. They do not create it. When you understand price, you understand the market at its core. When you depend only on indicators, you see a filtered version of reality. Another danger of indicators is false confidence. When traders see signals, they feel certain. They believe the trade will work. But certainty is dangerous in trading because the market is uncertain by nature. No signal is guaranteed. No setup is perfect. Overconfidence leads to bigger risk, and bigger risk leads to bigger losses. As Peter Lynch once said, know what you own and know why you own it. This idea applies to trading as well. You should know why you are taking a trade, not because an indicator told you, but because you understand the reasoning. Clarity creates control. Blind signals create dependency. And dependency is dangerous because when the tool fails, you feel lost. You do not know what to do next. This is why many traders keep changing indicators. They think, maybe this one will work better, but the problem is not the indicator. The problem is the mindset. No tool can replace understanding. No signal can replace discipline. The more you depend on external tools, the less you develop internal skill. And in trading, skill is everything. This does not mean indicators are useless. They can help. They can provide structure, but they should support your thinking, not replace it. Use them as guides, not as decisions. Keep your system simple. Too much information creates noise. Too much noise creates confusion, and confusion leads to mistakes. Simple charts, clear rules, strong discipline. This combination is far more powerful than complex systems. Think about it. The best decisions in life are often simple. Clear thinking leads to clear action. Trading is no different. When your mind is calm, you make better choices. When your charts are clean, you see opportunities more clearly. Simplicity is not weakness, it is strength. As Leonardo da Vinci once said, simplicity is the ultimate sophistication. This idea is deeply true in trading. The goal is not to add more. The goal is to remove what is unnecessary. Remove confusion. Remove noise. Remove dependency. And what remains is clarity. When you reach this stage, your confidence becomes stable. Not because you found a magic tool, but because you understand what you are doing. You no longer wait for perfect signals. You focus on good opportunities. You no longer feel overwhelmed. You feel in control. And that is a powerful shift, because trading is not about having more information. It is about using the right information wisely. Once you understand this, you stop searching for magic tools. You start building real skill. And that is what separates beginners from professionals. But even after simplifying your tools, another illusion still remains: the belief that more trading leads to more profit. And this illusion is one of the most dangerous, because it pushes traders into constant action. And that is exactly what we will uncover in the next chapter. Chapter 5. The Myth of High-Frequency Trading. After learning about strategies and indicators, many traders fall into another illusion: the belief that more trading leads to more profit. They think, if I take more trades, I will make more money. This idea feels logical. More action should mean more results. But in trading, this logic fails. Because trading is not about quantity, it is about quality. More trades do not increase success. They often increase mistakes. Every trade carries risk. The more you trade, the more risk you expose yourself to. And if your decisions are not perfect, losses begin to grow. This is how overtrading starts. At first, it feels productive. You are active. You are engaged. You feel like you are doing something important. But slowly, you begin to notice something. Your results do not improve. They become worse. Because activity is not the same as progress. Many traders confuse movement with achievement. They believe that being busy means being successful. But the market does not reward busyness. It rewards precision. Every trade should have a clear reason, a clear plan, a controlled risk. Without these, you are not trading, you are reacting. And reaction leads to emotional decisions. Another reason traders overtrade is boredom. When the market is slow, they feel the need to act. They do not like waiting. Waiting feels unproductive. So they force trades, or they enter without strong setups. They take positions without confidence. And these trades often fail. Patience is uncomfortable, but it is necessary. As Jesse Livermore said, "It never was my thinking that made the big money for me. It always was my sitting." This statement reveals a deep truth. Profit in trading often comes from waiting, not from constant action. The best opportunities are not frequent. They appear from time to time, and your job is to recognize them and act when they come. Not before, not after. But most traders do the opposite. They trade all the time and miss the moments that truly matter. Another danger of high-frequency trading is emotional exhaustion. Every trade affects your mind, win or lose. Your emotions move. More trades mean more emotional swings, and this leads to fatigue. When your mind is tired, your decisions become weak. You lose focus, you lose discipline, and mistakes increase. This creates a negative cycle. More trades, more stress, more mistakes, more losses. Breaking this cycle requires awareness. You must understand that trading is not about doing more. It is about doing less, but doing it better. Professional traders are not always active. They are selective. They wait for high-probability opportunities. They avoid unnecessary risk. They understand that not trading is also a decision, and sometimes it is the best decision. Think of trading like hunting. A skilled hunter does not chase every movement. They observe. They wait. They strike at the right moment. This approach saves energy and increases success. Trading requires the same mindset: observation, patience, precision. If you act on every signal, you lose control. If you wait for the right setup, you gain advantage. Another important point is cost. Every trade has a cost. Fees, spread, slippage. These may seem small, but they add up over time. The more you trade, the more these costs affect your results, even if your strategy is good. Overtrading can reduce your profits. This is why discipline is essential. You must choose your trades carefully. Not every opportunity is worth taking. Some are better left alone. Learning when not to trade is as important as learning when to trade. This is a skill that takes time to develop. But once you learn it, your results begin to change. You become calmer. You become more focused. You stop chasing the market. You let the market come to you. This shift creates stability. And stability is the foundation of success. Ask yourself a simple question. Am I trading because there is an opportunity? Or am I trading because I feel the need to act? This question can save you from many mistakes, because most bad trades come from impulse, not from logic. Control your impulses, and you control your trading. As Warren Buffett once said, the stock market is designed to transfer money from the active to the patient. This idea is powerful. It reminds you that patience is not passive. It is strategic. It is a choice. And it is one of the greatest advantages you can have. When you reduce unnecessary trades, you reduce noise, you focus on what matters, you improve your decision-making. And over time, your performance becomes more consistent. This is how professionals operate, not by doing more, but by doing less with greater precision. Once you understand this, you begin to respect the value of patience. You no longer feel the need to trade constantly. You feel comfortable waiting, and that comfort becomes your strength. But even with patience and discipline, another challenge still remains. A challenge that exists inside you: your emotions. Because no matter how good your strategy is, no matter how patient you become, if you cannot control your emotions, you will struggle, and that is what we will uncover in the next chapter. Chapter 6. The myth of emotional control is easy. After learning patience, after reducing unnecessary trades, many traders believe they are ready. They think, now I understand the system. Now I will stay calm. Now I will control my emotions. But this is another illusion. Emotional control is not easy. In fact, it is one of the hardest parts of trading, because trading is not just a technical activity, it is deeply psychological. Every trade you take involves uncertainty, and uncertainty creates emotion. Fear when the market moves against you. Greed when the market moves in your favor. Doubt when you are unsure. Hope when you want things to go your way. These emotions are natural, you cannot remove them, but you must learn to manage them. Many traders believe they will stay calm until real money is at risk. That is when everything changes. A small loss feels bigger. A small gain feels exciting. And suddenly, logic disappears. You know what to do, but you do something else. You hold losing trades longer than planned. You exit winning trades too early. You change your strategy in the middle of execution. All because emotions take control. This is why emotional discipline is more important than knowledge. You can have the best strategy in the world, but without control, it will fail. As Daniel Kahneman said, the idea that the future is unpredictable is undermined every day by the ease with which the past is explained. This means we believe we understand the market, but in reality, we only understand it after it is moved. This creates overconfidence, and overconfidence leads to poor decisions. Another emotional trap is revenge trading. After a loss, you feel the need to recover quickly. You want to prove yourself. You want to get your money back, so you take another trade. Without proper thinking, and often, this leads to more losses. This cycle can be dangerous. Loss creates emotion. Emotion creates impulsive action. Impulsive action creates more loss. Breaking this cycle requires awareness. You must recognize your emotional state. Before taking a trade, ask yourself, am I calm or am I reacting? If you are reacting, it is better to wait, because trading with emotion is like driving without control. Another common emotional mistake is fear of missing out. You see the market moving, you see others making money, and you feel left behind. So you enter late, without a clear plan, and often, at the worst possible moment. This is how many traders lose money. Not because the opportunity was bad, but because the timing was emotional. Patience protects you from this. Discipline protects you from this. But both require effort. Emotional control is not automatic. It is built through practice. It is built through awareness. It is built through experience. One powerful way to improve emotional control is to reduce risk. When you risk too much, your emotions become stronger. Every movement feels important, but when you risk less, your mind stays calmer. You think more clearly. This is why position sizing is important. It is not just about money, it is about psychology. Another helpful habit is following a routine. Have clear rules. Have clear entry and exit points. When you follow a system, you reduce emotional decisions. You act based on plan, not on feeling. Journaling can also help. After each trade, write what you did. Write how you felt. Over time, you will see patterns. You will understand your weaknesses. And awareness is the first step to improvement. As Marcus Aurelius said, you have power over your mind, not outside events. Realize this and you will find strength. This is the core of trading psychology. You cannot control the market, but you can control your reaction, and that control defines your success. Another important truth is this: you will never become emotionless, and you do not need to. The goal is not to remove emotion. The goal is to prevent emotion from controlling your actions. Feel it, but do not follow it blindly. This is the difference between amateurs and professionals. Amateurs react. Professionals respond. Reaction is instant and emotional. Response is calm and thoughtful. This small difference creates big results. When you learn to pause, when you learn to think before acting, you gain control. And with control comes consistency. Consistency leads to growth. This is the path of a disciplined trader. Not perfect, but controlled. Not emotionless, but aware. And once you develop this mindset, trading becomes less stressful. You stop fighting the market. You start understanding yourself. And that is where real transformation begins. But even with emotional control, another illusion still affects many traders: the belief that following the crowd is safe. And this belief can quietly destroy your progress. That is what we will uncover in the next chapter. Chapter 7. The Myth of Following the Crowd. After learning to control emotions, many traders begin to look outside for guidance. They join groups, they follow experts, they listen to popular opinions. At first, this feels helpful. You feel supported, you feel informed, you feel less alone. But slowly, a new illusion begins to grow. The belief that following the crowd is safe. If many people are buying, it must be right. If everyone is selling, it must be correct. This thinking feels comfortable because it removes responsibility. You are no longer deciding. You are following, but this comfort comes with a cost. The crowd is often late. By the time something becomes popular, the move has already happened. When the crowd enters, smart money often exits. This is why many traders buy at the top and sell at the bottom. Not because they are careless, but because they are influenced. The market is driven by psychology. Fear and greed spread quickly. When prices rise, greed increases. People see profits. They feel excitement. They rush to join. This pushes prices even higher, but eventually, the move slows down, and then it reverses. At this point, fear takes over. People panic. They start selling. And the cycle continues. This is how the crowd behaves. Emotional, reactive, late. If you follow the crowd, you follow these patterns. And these patterns lead to losses. As Howard Marks said, you cannot do the same things others do and expect to outperform. This is a simple truth. If you want different results, you must think differently. This does not mean you should ignore all information. It means you should think independently. Use information as input, not as instruction. Another problem with crowd behavior is noise. There are many opinions in the market. Some say buy, some say sell, some predict growth, some predict collapse. If you listen to all of them, you become confused. Confusion leads to hesitation. Hesitation leads to missed opportunities. Or worse, it leads to wrong decisions. Clarity is lost when too many voices are heard. This is why successful traders limit what they consume. They focus on their own system, their own rules. They trust their process. This creates stability. Instead of reacting to every opinion, they stay grounded. Another danger of following others is lack of learning. When you copy trades, you do not develop skill. You do not understand why the trade was taken. You only see the result. And without understanding, you cannot grow. True progress comes from thinking, from analyzing, from making your own decisions. Mistakes are part of this process, but they teach valuable lessons. If you avoid decision-making, you also avoid learning. And without learning, there is no improvement. Think about it. If someone gives you answers without explanation, you may pass the test once, but you will fail in the long run. Trading works the same way. You must build your own understanding. Another important point is responsibility. When you follow others, you blame others. If the trade fails, you say, they were wrong, but this mindset is dangerous because it removes accountability. And without accountability, you cannot improve. Successful traders take full responsibility. They accept their decisions. They learn from their outcomes. This mindset creates growth. Even when they make mistakes, they improve because they own their actions. Independence is not easy. It requires confidence. It requires discipline. But it is necessary. The market rewards those who think clearly, not those who follow blindly. This does not mean you must go against the crowd all the time. Sometimes the crowd is right. But the key is understanding. You must know why you are taking a trade. Not because others are doing it, but because it fits your system. This clarity protects you. It keeps you stable. It helps you avoid emotional decisions. As Warren Buffett once said, be fearful when others are greedy and be greedy when others are fearful. This does not mean always doing the opposite. It means being aware of extremes. It means not getting carried away by emotion. It means thinking independently. When you develop this mindset, you become less reactive. You stop chasing trends blindly. You stop panicking with the crowd. You begin to act with purpose. And that is where real strength lies. Because in trading, your greatest advantage is not speed. It is clarity. And clarity comes from independent thinking. Once you stop relying on the crowd, you begin to trust yourself. And trust is powerful. It creates confidence. It creates consistency. And consistency leads to growth. But even after developing independence, another illusion still affects many traders. The belief that news and predictions can guide the market. And this illusion often creates false confidence. That is what we will uncover in the next chapter. Chapter 8. The Myth of News and Predictions. After learning to think independently, many traders turn to another source of guidance. News, experts, predictions. They believe, if I know what will happen next, I can profit easily. This idea feels logical. If you can predict the future, you can control your results. But in trading, this belief is misleading because the future is uncertain. No one knows exactly what will happen next. Not analysts, not experts, not institutions. Yet the world of trading is full of predictions. People constantly say, the market will go up, the market will go down. They speak with confidence. And this confidence attracts attention. It makes people believe. This person must know something. But confidence is not accuracy. Many predictions are wrong, even when they are right. It is often by chance. The problem is not information. The problem is interpretation. News does not move the market in a simple way. Sometimes good news leads to falling prices. Sometimes bad news leads to rising prices. This confuses many traders. They expect a direct connection. But the market is more complex. It reacts to expectations, not just events. By the time news becomes public, the market has often already adjusted. This is why many traders enter too late. They hear the news, they see the move, they jump in, and then the market reverses. This creates frustration. They feel misled. But the truth is simple. They were reacting, not anticipating. Successful traders focus on price. Price shows real-time behavior. It reflects what the market is doing now, not what someone thinks it will do. Predictions focus on the future. Price focuses on the present, and in trading, the present is more reliable. Another danger of predictions is emotional attachment. When you believe a prediction, you become biased. You want the market to follow that view. If it moves against you, you ignore the signal. You hold your position, hoping it will turn. This creates losses. Because you are no longer objective. You are attached. Attachment is dangerous in trading. It clouds judgment. It delays decisions. A good trader remains flexible. They adapt to what is happening, not to what they expected. As John Maynard Keynes said, "When the facts change, I change my mind." What do? This mindset is powerful. It allows you to stay aligned with reality, instead of being trapped by opinions. Another issue with news is overload. There is too much information. Economic data, global events, market analysis. Trying to follow everything creates stress, and stress reduces clarity. When your mind is full, your decisions become weak. This is why many successful traders limit their information sources. They focus only on what matters. They avoid unnecessary noise, because clarity is more valuable than quantity. Another important truth is this: markets do not move in a predictable way. Even if you understand the news, you cannot control how others will react, and the market is a collection of many participants, each with different views, different strategies, different emotions. This creates uncertainty, and uncertainty cannot be predicted perfectly. Trying to predict everything is exhausting. It creates pressure, and pressure leads to mistakes. Instead of trying to be right about the future, focus on being prepared. Preparation is different from prediction. Preparation means having a plan. It means knowing what to do in different situations. If the market rises, you know your action. If the market falls, you know your response. This approach creates stability. You are not guessing. You are responding. And this makes a big difference. Another benefit of avoiding predictions is emotional freedom. You stop worrying about being right. You focus on following your process. This reduces stress, this improves discipline, and discipline leads to consistency. As Peter Drucker said, the best way to predict the future is to create it. In trading, you create your future through your actions, through your discipline, through your risk management, not through guessing. When you accept that you cannot predict the market perfectly, you become calmer. You stop chasing certainty. You start respecting uncertainty. And this shift improves your decision-making. You become more flexible. You become more focused. You act based on what is happening, not on what you hope will happen. This is the mindset of a professional, not a predictor, but a responder. And once you develop this mindset, you begin to see the market more clearly. You are no longer influenced by every headline. You are no longer trapped by every opinion. You stand grounded in your own system, and that creates strength. But even after understanding this, another illusion still holds many people back: the belief that you need a large amount of money to succeed in trading. And this belief stops many from even starting. That is what we will uncover in the next chapter. Chapter 9. The Myth of Big Capital Needed. After understanding that predictions cannot guarantee success, many people face another belief, the belief that you need a large amount of money to succeed in trading. They think, I cannot start because I do not have enough capital. They look at big traders, they see large accounts, they see huge profits, and they assume that is the only way to succeed. But this belief is misleading. Capital is important, but it is not the starting point of success. Skill is. Without skill, even a large amount of money can disappear quickly. With skill, even a small amount can grow over time. This is the truth that many ignore. They focus on how much money they have, instead of how well they can manage it. But trading is not about size. It is about control. If you cannot manage a small account, you will not manage a large one. In fact, a larger account increases pressure. More money means more emotion. Every loss feels bigger. Every decision feels heavier. If you are not prepared. This pressure can lead to mistakes. Starting small has advantages. It reduces risk. It allows learning. It builds confidence. You can make mistakes without serious damage, and mistakes are part of the process. They teach lessons that cannot be learned in theory. As Jesse Livermore said, "The game taught me the game, and it did not spare me the rod while teaching." This means experience is the real teacher, and experience comes from doing, not from waiting for perfect conditions. Many people delay their journey. They say, I will start when I have more money. But this delay slows their progress, because trading is a skill, and like any skill, it improves with practice. The sooner you start learning, the sooner you improve. Another important point is mindset. When you start with a small account, you focus on process. You think about discipline. You think about risk. But when you start with a large amount, you may focus only on profit, and this creates imbalance. Profit without discipline is unstable. It may work for a short time, but it does not last. Growth requires a strong foundation, and that foundation is built through small steps. Consistency matters more than size. If you can grow your account steadily, even slowly, you are on the right path, because consistency can scale. A disciplined process can be applied to any amount of capital, but a weak process will fail, no matter how much money you have. Another common mistake is unrealistic expectation. People think, if I had more money, I would make more profit. This is partly true, but only if your system is already strong. If your system is weak, more money will only increase losses. This is why professional traders focus on percentages, not absolute numbers. They measure performance based on consistency, not size. Because percentage growth reflects skill. And skill is what creates long-term success. Think of trading like building a muscle. You do not start with heavy weight. You start small. You build strength gradually. Over time, you increase capacity. This approach reduces injury and improves performance. Trading follows the same principle. Start small. Build discipline. Increase gradually. This creates stability. Another benefit of starting small is emotional control. With lower risk, your emotions stay manageable. You can think clearly. You can follow your plan. This helps you build good habits, and habits define your future performance. If you develop bad habits early, they will grow stronger over time. If you develop good habits early, they will support your growth. So the size of your starting capital is not the most important factor. Your behavior is. Your discipline is. Your consistency is. These are the real drivers of success. As Warren Buffett once said, chains of habit are too light to be felt until they are too heavy to be broken. This applies directly to trading. Your habits will shape your results. Build them carefully. Do not wait for the perfect amount of money. Start with what you have. Focus on learning. Focus on improving. Money will follow skill, but skill will not follow money. This is a powerful truth. When you understand this, you stop using capital as an excuse. You take responsibility. You begin your journey. And that is the most important step, because progress only happens when you start. But even after starting, another illusion still traps many traders: the belief that trading is similar to gambling, and this belief can quietly destroy discipline. That is what we will uncover in the next chapter. Chapter 10. The Myth of Trading as Gambling. After starting with the right mindset about capital, many traders face another dangerous belief: the belief that trading is just like gambling. At first, this idea may not seem harmful. Some even say it casually. Trading feels like a game. It feels exciting. It feels unpredictable. And because of this feeling, they begin to treat it like gambling. They take random trades. They rely on luck. They hope for big wins. But this approach leads to failure, because trading and gambling are not the same. They may look similar on the surface, but they are very different at the core. Gambling is based on chance. There is no control over the outcome. The odds are usually against you. In most gambling activities, the system is designed so that the player loses over time. Trading is different. Trading involves uncertainty, but it is not pure chance. There are patterns. There are behaviors. There are probabilities. A skilled trader studies these elements. They build a system. They manage risk. They create an edge. This edge may be small, but over time, it makes a difference. As Ed Seykota said, the elements of good trading are cutting losses, and cutting losses. This shows that trading is about discipline, not luck. Another key difference is control. In gambling, you have limited control. In trading, you control your actions. You choose when to enter. You choose when to exit. You choose how much to risk. These choices shape your results. If you act randomly, your results will be random. If you act with discipline, your results become consistent. This is the separation between a gambler and a trader. A gambler seeks excitement. A trader seeks stability. A gambler focuses on winning big. A trader focuses on managing risk. A gambler reacts emotionally. A trader follows a plan. Many traders fail because they mix these two mindsets. They start with a plan. But when emotions rise, they switch to gambling behavior. They increase their risk suddenly. They ignore their rules. They chase losses. They hope for recovery. And this leads to destruction. Another sign of gambling behavior is lack of preparation. A trader prepares before entering a trade. They analyze the situation. They define risk. They set exit points. A gambler does none of this. They act in the moment. They rely on feeling. This creates inconsistency. Consistency cannot come from randomness. It comes from structure. Another important factor is expectation. Gamblers expect quick results. They want fast rewards. Traders think long-term. They understand that success comes from many trades, not one big win. They focus on process, not outcome. As Paul Tudor Jones said, "Don't focus on making money. Focus on protecting what you have." This mindset is critical because once you protect your capital, you give yourself time to grow. But if you chase big wins, you expose yourself to big losses, and one big loss can end your journey. Another difference is emotional stability. Gambling creates strong emotions: excitement when winning, despair when losing. These emotions create addiction. You begin to chase the feeling, not the result. This is dangerous because trading should not be about excitement. It should be calm. It should be controlled. If trading feels like a thrill, you are likely doing something wrong. Professional traders often describe trading as boring because they follow routines. They repeat the same process. They do not chase excitement. They chase consistency, and consistency creates long-term success. Another important point is responsibility. Gamblers blame luck. If they lose, they say it was bad luck. Traders take responsibility. They review their actions. They learn from mistakes. They improve their system. This mindset leads to growth. Blaming luck leads to stagnation. You cannot improve what you do not take responsibility for. So ask yourself honestly, are you trading or are you gambling? Do you have a plan? Or are you guessing? Do you manage risk or do you chase reward? These questions reveal the truth. If you want to succeed in trading, you must leave the gambling mindset behind. You must build discipline. You must follow rules. You must think long-term. This transformation is not easy, because the human mind is attracted to excitement, but success requires control. It requires patience. It requires awareness. When you shift from gambling to trading, everything changes. Your decisions become clearer. Your emotions become stable. Your results become consistent. This is the path of a professional, not driven by luck, but guided by discipline. And once you make this shift, you begin to see trading for what it truly is: a skill, a process, a long-term journey. But even after understanding this, one final truth remains. A truth that connects everything you have learned so far: the reality of consistency. And that is what we will explore in the next chapter. Chapter 11. The reality of consistency. After breaking all the major illusions, a deeper truth begins to appear. Trading success is not about brilliance. It is about consistency. This idea may sound simple, but it is often misunderstood. Many traders think success comes from big wins. They imagine one perfect trade changing everything, but real success does not work like that. It is built slowly, trade by trade, decision by decision. Consistency means doing the right things again and again, not once, not sometimes, but every time. It means following your rules even when it feels difficult. It means staying disciplined even when emotions rise. It means accepting small gains and small losses without reacting. This is not exciting. In fact, it can feel boring. But this is where real growth happens. As John C. Bogle said, "Stay the course." This simple idea carries deep meaning. It means do not change your approach based on short-term results. It means trust your process, because consistency builds results over time. Another important truth is this: inconsistent behavior creates inconsistent results. If you follow your rules one day and break them the next, your outcomes will always be unstable. You may have good days. You may have bad days, but you will not have progress. Progress requires stability. Stability requires discipline. This is why many traders struggle. Not because they lack knowledge, but because they lack consistency. They know what to do, but they do not do it regularly. They let emotions interfere. They let distractions take control. And this breaks their process. Consistency is not about perfection. You will still make mistakes. You will still face losses. But you continue to follow your system. You continue to improve. Over time. This creates growth. Think of consistency like building a habit. At first, it feels difficult. You must remind yourself. You must stay aware. But slowly, it becomes natural. Your actions become automatic. You no longer struggle to follow your rules. You simply follow them. This is where discipline turns into identity. You become a disciplined trader. Another key element of consistency is risk management. If your risk changes randomly, your results will also change randomly. You must define how much you risk per trade, and you must stick to it. This protects your capital. It keeps your emotions stable. It allows you to survive losing periods, because losses will happen, even with a strong system. Consistency ensures that these losses do not destroy you. Instead, they become part of the journey. As Paul Tudor Jones said, "Don't focus on making money. Focus on protecting what you have." Protection creates longevity. Longevity creates opportunity. Opportunity creates growth. This chain is powerful. Another aspect of consistency is patience. Results take time. You may not see immediate progress. You may doubt your system. You may feel tempted to change everything. But this is where consistency is tested. Can you stay the course when results are slow? Can you trust your process when nothing exciting happens? This is the real challenge, because the human mind wants quick results. It wants proof. But trading does not always provide instant feedback. Sometimes, you must continue without visible reward. And this requires belief. Not blind belief, but informed belief. Belief built on understanding your system. Belief built on experience. Another powerful benefit of consistency is confidence. When you follow your process regularly, you begin to trust yourself. You know what you are doing. You know how you react. This self-awareness creates strength. You are no longer shaken by every outcome. You remain stable. This stability improves your performance because clear thinking leads to better decisions, and better decisions lead to better results. Consistency also reduces stress. When you follow a system, you remove uncertainty from your actions. You know what to do. This reduces overthinking. It creates calmness. And calmness is a powerful advantage in trading. Another important truth is this. You do not need extraordinary skill to succeed. You need ordinary actions done consistently. This is what creates extraordinary results. Small gains repeated over time become significant. Small improvements repeated over time create mastery. This is the power of consistency, as James Clear said. You do not rise to the level of your goals, you fall to the level of your systems. This means your daily actions define your outcome, not your intentions, not your plans, but what you actually do. So focus on your system. Refine it. Follow it. Do not chase perfection. Chase consistency. Because consistency is sustainable. And sustainability leads to long-term success. When you understand this, your perspective changes. You stop looking for big wins. You start building steady progress. You stop reacting to short-term results. You focus on long-term growth. And this shift is powerful because it aligns you with reality. The reality that trading is a journey, not a single event. A journey that rewards discipline. A journey that rewards patience. A journey that rewards consistency. And once you fully accept this truth, you are no longer chasing success. You are building it. Step by step. Trade by trade. Day by day. But even with consistency, one final transformation is needed. A transformation in how you think about the entire process. The development of the right mindset. And that is what we will explore in the next chapter. Chapter 12. Building the right mindset. After understanding consistency, after developing discipline, a deeper layer of trading begins to reveal itself. Mindset. This is the foundation of everything. Your strategy matters. Your risk management matters. Your discipline matters. But all of these are controlled by your mindset. If your thinking is weak, your actions will be weak. If your thinking is strong, your actions will follow. Many traders focus only on techniques. They search for better entries. They search for better indicators. But they ignore their thinking patterns. And this creates imbalance. Because trading is not just about what you do, it is about how you think. The right mindset begins with accepting reality. The market is uncertain. There are no guarantees. You cannot control outcomes. You can only control your actions. This acceptance removes pressure. You no longer try to be right all the time. You focus on doing the right thing. This is a powerful shift. Another important part of mindset is detachment. You must detach from individual trades. Do not see each trade as a test of your ability. Do not connect your self-worth to outcomes. Because outcomes are uncertain. If you attach your emotions to results, you will suffer. A loss will feel like failure. A win will create overconfidence. Both are dangerous. Instead, see each trade as one step in a long journey. Just one moment, not a final result. This creates emotional balance. You remain calm. You remain focused. Another key element is patience. We have talked about patience before, but here it becomes deeper. Patience is not just waiting for trades. It is waiting for growth. It is accepting slow progress. It is understanding that mastery takes time. As Lao Tzu said, nature does not hurry, yet everything is accomplished. This idea is powerful. Growth is natural, but it cannot be rushed. Trying to rush success creates mistakes. Allowing time creates stability. Another important mindset is responsibility. You must take full ownership of your results. No blaming the market. No blaming news. No blaming others. Every decision you make is yours. This mindset creates control because when you take responsibility, you can improve. If you blame external factors, you remain stuck. Growth requires ownership. Another key aspect is adaptability. The market changes, conditions evolve. What worked before may stop working. You must be flexible, not emotional, but adaptable. This means reviewing your system, making adjustments when needed, but not changing everything impulsively. Balance is important. Stability with flexibility. Another powerful mindset is humility. The market is bigger than you. It does not care about your opinion. It does not reward ego. If you think you know everything, you will stop learning. And when you stop learning, you start losing. Stay humble. Stay open. Stay curious. This keeps you growing. As Socrates said, the only true wisdom is in knowing you know nothing. This mindset keeps you grounded. Another important element is focus. There are many distractions in trading. News, opinions, social media. All of these can pull your attention away. You must protect your focus. Focus on your system. Focus on your rules. Ignore what is not relevant. This creates clarity. Clarity improves decision-making. And better decisions lead to better results. Another key mindset is resilience. You will face losses. You will face difficult periods. There will be times when nothing works. During these times, your mindset is tested. Do you give up or do you continue? Resilience means continuing with discipline, not blindly, but with awareness. Learning from mistakes, improving your process. This is how growth happens. Every challenge becomes a lesson. Every loss becomes an opportunity to improve. This mindset transforms difficulty into progress. Another powerful shift is long-term thinking. Most traders focus on short-term results. They judge themselves daily. This creates pressure. Instead, think long-term. Measure your progress over months, over years. This reduces emotional swings. It creates stability. Because one bad day does not define you. One good day does not define you. Your long-term behavior defines you. As Warren Buffett once said, our favorite holding period is forever. This idea reflects patience and long-term thinking. It reminds you to focus on durability, not short-term excitement. When you develop the right mindset, everything begins to align. Your actions become disciplined. Your decisions become clear. Your emotions become stable. You no longer chase the market. You work with it. You no longer seek certainty. You accept uncertainty, and this acceptance creates peace. Trading becomes less stressful, more structured, more controlled. This is the transformation, from reacting to responding, from guessing to planning, from chasing to building. And once you reach this stage, you are no longer controlled by illusions. You see the market clearly. You see yourself clearly. And that is where real success begins.